Hello, welcome to Strategic Management. In this session I'm going to be discussing managing portfolios. So this is a continuation of the theme of corporate level strategy. Previously I've discussed the role of the corporate center or the corporate parent, the relationship of the corporate parent with the operating businesses within their portfolios. In this session I want to focus more on the logic of the portfolio, or how they actually make the big corporate decisions about which businesses they wish to be in, which businesses they're going to invest in, and perhaps which businesses they wish to divest or sell off. So, to give you an idea of the problems that are faced by corporations, by the corporate parents, here's some data on Rolls-Royce. So Rolls-Royce is generally a technology-based engineering business, and they have a number of different divisions you can see listed there: civil aerospace, defense, power systems, marine, and nuclear. And you can see that these different divisions have different levels of revenue. Also, they produce different levels of profit, both in terms of the pounds profit, but also more importantly in terms of the level of profitability, the percentage of profits. And then in addition, the different markets which these different divisions are in are growing at different rates. So the big question for Rolls-Royce is, with the limited investment available to them, where should they place that investment in order to benefit the group as a whole, for the whole group to grow, and importantly, of course, to improve the profitability of the group. So some of the key issues facing a corporate parent is, what level of investment should they place in different businesses? So what's the level of growth that's forecast for each of the different industries or businesses that they have within their portfolio? Importantly, what level of return might they receive once they've made that investment? And just as importantly, what risks do they face in terms of the markets and the competition that exists in those different marketplaces? To make these sorts of decisions and to understand the balance of the portfolio in terms of these different variables, the Boston Consulting Group came up some years ago with a matrix which they derived to help their customers, large corporations, in deciding exactly how to make these investment decisions. So they looked at two variables. Obviously the market growth. Firms want to be in markets that are growing. It's far easier to grow a business in a growing market. And then also they looked at market share. And they looked at these two variables in terms of the difference between low market growth and low market share, and then high market share and high market growth. The variable of market share was chosen because most often high market share is associated with higher profitability. So with these two variables, we ended up with our classic 4-panel matrix, so beloved of strategic analysis. And in the different regions of this matrix, there are 4 different definitions of the sorts of business that might be present in a portfolio in terms of the market growth and the market share that they hold. So in the bottom left-hand corner, with low market growth and low market share, we have the dogs or problem children. These are the businesses which most corporations do not wish to have within their portfolios. What lots of businesses are looking for are those businesses with high market share, so they have high profitability perhaps, but the market isn't growing, so it's very stable, and that helps make sure that there is a steady flow of cash which can be used to finance other businesses within the portfolio. In the top left-hand corner, we've got high market growth businesses, but they have low market share. So the question is, can the market share of these businesses be grown? Can they get bigger? Can they take advantage of that market growth? Can they compete strongly enough in order to gain market share and to grow. Top right hand corner, we've got those businesses which might be in high growth markets and they have a high market share. And these are businesses that are beloved by corporations and investors. Investors want to see exciting futures for some of their businesses which they're investing in. They want high market growth and they want high market share so that they can see there is a good prospect of high returns. The characteristics of these different businesses vary in these different sections. The dogs or problem children the dogs, problem children are the question marks. The dog businesses are in low or declining growth markets. They have a low share, and so there's likely to be very, very little prospect of a good return. So these businesses drain the resources, investment and management time, resources which would be best placed in other businesses. Now this description of dogs is principally from the perspective of the existing parent company. What for one business is slow growth or low market share, for other businesses it might be a very good market share and a very good rate of growth, one which they're happy with. So one corporate parent defining their business as a dog does not necessarily mean that it's a bad business, and it might be very attractive to other businesses. So we saw earlier that portfolio managers are looking for businesses which haven't been performing well, and that might be because of the low resource that's been put into those businesses by their parents. Take them out of that portfolio, invest in them properly, and we may start to see some better growth. Question marks or problem children are businesses which have got a low share, but they're in markets which are exhibiting good growth. The problem with these businesses is they do need high investment, but is that investment going to be sufficient to increase the competitive advantage, the ability of that business to gain market share and therefore return a high level of profitability? So these are high risk. It's a question. If we put investment in, will we gain the market share? Will we get the return? Cash cows, on the other hand, are stable, mature businesses, slow growing markets, low risk. They don't require lots of investment, but they're steadily producing a high level of profit and cash flow, which can be used to fund the investment that's required in other businesses. So cash cows are beloved of corporations and investors because they provide the investment for other businesses. Particularly, of course, they provide the investment that stars require. Stars are those exciting businesses. The markets are growing quickly. They've got high market share so they can compete, but they do need high investment. But they do promise, not necessarily currently, but there is always the promise that eventually they will deliver a very good level of profitability. So a corporation needs to look at its different divisions, its different businesses, and understand where the investment is required, where the growth is going to come from, where the investment is going to be coming from, and where the profit's going to be made. And it's this balance that a corporation or a corporate parent needs to manage. They need to manage that balance, and they need to manage the investment across these different businesses. And sometimes they have to make difficult decisions. Should they provide investment? What level of investment? Or should they be considering selling off the business? Perhaps because it's not got sufficient growth for their objectives, or perhaps because it no longer fits into the portfolio in terms of its level of relatedness to the other businesses. So if we look back at the Rolls-Royce example, then we can start to classify these different businesses by understanding what the macro environment promises for these different businesses, what's changing which may produce opportunities or threats. So civil aerospace for Rolls-Royce, supplying engines for commercial airliners, is a big growth market. They already have a good share. They already have a high level of profitability. So that's a star business which they want to continue investing. The power systems business is a mature business, a reasonable rate of return, low investment required, but it will produce cash and profit which can be invested in the other businesses. The defense system is surrounded by problems. It has a low market outlook because there is great uncertainty about the future spending of governments on defense systems. So should they invest in that? Are they big enough to secure sufficient growth in the future and continue what might be a high level of profitability at the moment, but with low market outlook? Is that a business they should continue in? Similarly, the nuclear business in which they have, very small at the moment, and uncertainty over the desire for continuing nuclear power generation and nuclear submarines. So that's a huge question mark. The marine business, low profitability, low market outlook, and not a huge size, not a great market share. So that might be a business that doesn't fit so easily into the portfolio in terms of the level of return that's offered or the relatedness to other businesses. So that might be considered to be a business that can be released, sold off, and the finance that's raised from that can be invested in the divisions which can produce more profit in the future.